So kind of a mixed quarter here with Walmart's first quarter. A large miss for profit, much larger than we normally see. The retailer reporting $1.30 adjusted compared to an expected $1.48 per share, but on stronger sales of $141.57 billion. Estimates were looking for $138.94 billion. And Walmart doesn't typically adjust guidance at this point in the year. It is doing it here, increasing its sales and lowering profit expectations for the year. U.S. comparable sales here growing more than expected at 3%. Sam's Club grew more than 10% for the first quarter. Grocery, again, a sales and traffic driver. Walmart's U.S. net e-commerce sales grew just 1%. That is the same growth rate as we saw last quarter, down sharply from previous growth rate trends, though still up 38% on a two-year basis. Ad sales, that's a new business, grew 30% globally, also pretty high margin. I did speak briefly to CFO Brett Biggs, who said there were a number of issues impacting profitability in the quarter, from the higher cost of fuel, aggressive inventory purchasing, and then some delays, higher COVID costs related to being overstaffed as employees returned more quickly than expected, though Biggs said that has since been resolved. Biggs thought that the supply chain issues that pressured costs would abate during the quarter, but they didn't. Biggs also did note that the second quarter is off to a strong start from a sales perspective, which is why the retailer increased sales guidance for the year. Interestingly, though, Biggs said that the customer overall seems okay, but acknowledges there's some behavioral changes from inflation.
This has obviously been a pretty difficult quarter. What happened?
Well, first of all, Becky, I appreciate being here during a difficult report.
Right.
But it's a chance to talk about kind of our business and where things stand. And I frame it by really looking at kind of the front of the house of our business and then the back of the house. And if I think about the front of the house, the consumer guest-facing component, we saw really strong comps, over 3%.
Bruh.
23% last year. And importantly, it was driven by traffic. Traffic up 4% on top of 17% last year. Guests are shopping our stores, they're enjoying our services, they're using Drive Up. But clearly, the challenge for us in this quarter was the back of house. From a freight and transportation standpoint, things have changed significantly from even 13 weeks ago.
All right. Today is Wednesday, May 18th, and this is a recap for the stock market activities today. Folks, yes, I got a good one for you tonight, despite everything. Lots of pain out there. It is falling apart. You see it, I see it, everybody's seeing it. But hey, keep your head up, because whatever you're going through right now, well, it pales in comparison to this. Woman left on life support after excited dog crashes into her while playing. And rumor has it, the woman said, "Good boy," and the dog got pissed off and put her in life support. Apparently, the dog did not like being misgendered, so be careful next time around you call your dog good boy, good girl. Just keep it to good dog, and that's about it. And now that you kept your head up for a little bit, it's time to put it down again. You know why? Because yesterday we talked about the British economy falling apart. And what do you know? Overnight, we got the information. The UK inflation is now at 40-year high at 9%. Remember that the governor of the Bank of England said by the end of the year, it's going to be 10%. We are already at 9% in April. But of course, we all know that the real inflation numbers are, you just add a 10 to whatever they give you. So inflation is at 19% right now in the UK. So this was bad news number one. And U.S. equities futures responded negatively to this piece of news right away. And then came, now remember this, yesterday we got the disaster from Walmart. A lot of folks brushed that off as, okay, this is just Walmart, but wait till you see Costco and Target. Well, today in the morning we got Target and it confirmed something really, really ominous in this economy. Target went down big, so did Walmart and everything else. Look at these losses. Unbelievable so far. We're talking for the week so far. Walmart is down almost 19%. Target is down almost 30%. Again, this is only for the week so far, but this crash was contagious across all consumer staples. Look at Costco, for example, down almost 15% for the week so far. Kroger, down 12% so far. You got names like General Mills, which we talked about not so long in this program as one of the bullish names. Well, now it's down almost 9% for the week so far. A name like Hershey's, which I own in my portfolio, a name that is so defensive, it has been bucking the negative trend in the equities market overall, but even Hershey's is down 9.5% so far this week. He's Procter & Gamble, another outperformer year to date, another ultra defensive name. Well, it's down almost 8% for the week so far, and the pattern doesn't look good at all. Even retailers across the board. Take, for example, one of the strongest names in retail, Lululemon. It's down almost 15% for the week so far. Unbelievable destruction here. And folks, when we talk about the consumer defensives, the stores, Costco, Walmart, Target, or even the consumer brands like Kraft, Kellogg's, General Mills, Mondelez, etc. When these names crash, we got a massive problem here. We got an ominous sign for this economy because the name gives it away. These are defensive. They're supposed to be inflation hedges. Well, if inflation is crushing these names now, do we have anything left to hide in? And by the way, it's not just an ominous indicator for the stock market. It is also an ominous indicator for the entirety of the economy because the results are showing that there is something major that just happened. We're going to talk about it and a lot more. So let's not waste any more time, and here it is in focus tonight. Game over. This is at least what Walmart results say. If Walmart goes down, it's over for the economy. Let's back up here and track the sequence of events. And this is what I've been talking about for a while now. The mistake of the century, courtesy of the Federal Reserve, of course. The Dow lost over 1,000 points today. The stock market is in a free fall. The economy is in a free fall. Inflation is surging out of whack with no stop in sight. And the Federal Reserve remains way behind the curve. And here's the sequence of the crime of the century, the mistake of the century by the Federal Reserve. Number one, print, baby, print. We got that right after the great panic of 2020 when the stock market crashed. And to preserve the wealth of the rich in stocks and real estate, the Federal Reserve responded by unleashing the tsunami of liquidity. The biggest wave of liquidity in human history. We've never seen anything like this before. Trillions and trillions and trillions of dollars. Look at the Fed's balance sheet, for example. We went, before the Great Panic, from around $4 trillion in the Fed's balance sheet to almost $9 trillion right now. So we're talking about almost $5 trillion added to the Fed's balance sheet in a short amount of time. As a response, what happens? That money doesn't disappear in a black hole in the economy. It goes on into chasing stocks, it goes on into chasing risk, and therefore we've seen phenomenons in the stock market such as meme stocks and garbage stocks moving higher, cryptos and tulips, Bitcoin moving higher. Nothing makes sense at all. That money also went into stimmies, courtesy of the government, and the consumer spent that in the economy like crazy. You give the consumer free cash, what do you think they're going to do with it? They're going to spend it in the economy. And therefore, we've seen retail sales, for example, exploding higher, the highest readings in history in 2020 and 2021. And this caused a massive wave of demand in the economy, the likes that we've never seen before. So we now have excess demand in the economy. Everybody has cash, and they're spending, splurging all over the place. So what happens as a result when you have all of a sudden an increase in demand, and oh, by the way, the supply chain is getting hammered due to the lockdowns from the thing. And in either case, whether we have lockdowns from the thing or not, there is no supply chain prepared for this level of demand because we're talking about trillions and trillions and trillions of dollars floating in the economy all of a sudden. So what happens? Step number 3 is the supply chain becomes overwhelmed. And an evidence for that is, look no further than the oil processing capacity in the United States. It is at the lowest level in decades. Another piece of evidence is the trade deficit. When you have consumers flush with cash, spending like crazy, what do you think will happen? The majority of our goods come from overseas, from China. When a country has more imports than exports, you have a massive trade deficit. And we have the biggest trade deficit in history due to the insane wave of liquidity. Another piece of evidence, the global supply chain woes are still with us right now. Just when you thought that the global supply chain woes are easing, well, they went higher for the first time this year in the month of April. And as you can see, this is from the New York Fed. When we look at the standard deviation of the average value in the New York Fed Global Supply Chain Pressure Index, we're back at the highs again. We've never seen these levels before. Why? Because it is not a supply problem. Inflation, as Dr. Friedman taught us, has always been a monetary phenomenon. The Fed prints more cash than the economy needs. Well, you get inflation. Whether you have the best supply chain in the world or not, when you have excess demand, there is no supply chain in the world, in the universe, that can cope with this level of demand. And we all remember the scenes at the ports of LA with the giant ships backed up. Well, we're not seeing any relief in sight. The supply chain remains backed up.
So, Gene, is the supply side crisis that we've all been so focused on starting to go away now? Are we moving on from it, or do you think this is going to be still a problem for a while?
Good afternoon, Guy. This is going to take some time. There's an episode just about every day that impacts us in the supply chain, whether it's on the ground, the atrocities in Ukraine impacting energy and agriculture goods flow, the lockdowns in Shanghai, 8.3% inflation, producer prices going up 11%. All of this is in the supply chain equation.
So what happens when you have an insane money printing scheme followed by an insane rise in demand, excess demand in the economy that caused the supply chain to become overwhelmed dramatically? Well, you get inflation. It's no secret, everybody knows by now that we have the highest inflation in 40 years at a minimum. This inflation is not stopping anytime soon. For example, last week we got wholesale inflation and the reading was 11% in April. Producer prices continue to accelerate in a rapid pace. We know that the producer price index is a leading indicator to the consumer price index. So for now, you have the producer price index at 11%. And these are, by the way, the cooked numbers. You always add a 10 to get the reality of inflation in this country. But regardless, the producer price index is at 11%. The consumer price index is at around, let's say, 8.5%. Sooner or later, the consumer price index will be at 11% because producer prices are a leading indicator to consumer prices. We're seeing insane inflation across the board. Chicken wings for $34 in this country? Yes. And it could climb even higher. This is an inflation the likes that we've never seen before. And wage inflation is part of it. We're seeing wages increasing across the board. We have a labor shortage and we have an insane demand in the economy. Companies are competing over labor, so they have to make their wages competitive. Now, when they increase wages, what does that mean? Workers are getting paid more and they can compete in the economy more on rents, on cars, on goods, on services, and that results in more and more inflation, and the end result is workers fall behind inflation at some point. We're already seeing that happening right now. Wage inflation at around 5.5%, CPI inflation at 8.5%, net workers are down about 3 points. We're seeing the minimum wage in California rising to $15.50 an hour. And even at this stage of inflation, we're seeing companies also boosting wages. Microsoft boosting wages in certain cases by more than 50% in order to retain talent. Because workers have other options now. They can stay at home, take a break, stay at home for a while. They can move to another company and secure higher salaries. So companies like Microsoft have to pay more in order to retain employees. Inflation is surging out of whack, be it energy inflation, be it food inflation, be it rent inflation, be it commodities inflation. Everything is moving higher, and we're not seeing any relief in sight. But perhaps one of the most destructive elements in this inflation is diesel inflation. The prices of diesel are surging significantly higher, the highest of all time, record highs. Now, diesel happens to be the backbone of this country. Why? Because we pretty much transport all of our goods using trucks and railroads from coast to coast. Trucks and railroads use diesel. Well, if these prices surge out of whack, well, they're going to pass all of that cost down to the end consumer, you and I, baby. And we see more and more and more inflation. Now, what happens when inflation reaches extreme levels in the economy? Well, it crushes the budget of the consumer. Everything is passed down to the consumer. For rents, utilities, energy, grocery store, everything is being passed down to the end consumer. At some point, After the consumer runs out of the stimmies and swiping those credit cards up and down, up and down, up and down, well, they're running out of spending power, while inflation continues to move higher and higher and higher. What will the consumer do as a response? Well, they're going to rethink their spending habits, and they're going to limit their spending to essentials, meaning they're going to cut down on spending that is deemed unnecessary, such as buying cars or traveling or eating at restaurants, for example, because now they have to pay more for gas at the pump, for food in the grocery store, for rent, for utilities, so the consumer spends less while inflation continues to move higher. And that results in consumer sentiment moving down dramatically. Matter of fact, we're seeing the lowest reading in more than a decade. Consumer sentiment is collapsing, according to the University of Michigan. On top of that, the buying conditions for durable goods, for example, these are the weakest reading in history. We've never seen the consumer in such a gloomy mood before, thanks to inflation, of course. And here it is, the consumer has been swiping those credit cards up and down, racking up trillions of dollars in debt, $52 billion alone in March. And this is the highest reading in history. And this is really alarming, folks, because what happens when the consumer racks up an insane amount of debt on their credit cards, and on top of that, they lose their jobs at some point, and then we see interest rates moving higher? This will be a disaster, the likes that we've never seen before. And here it is, which will lead us to the segue to Walmart and Target. As inflation continues to move higher, the consumer has to cut back on spending, and that becomes a self-fulfilling prophecy that brings on a recession. Why is the consumer cutting down spending? Well, look at rents. Look at electricity and gas bills, for example, surging out of whack. And therefore, the consumer has to cut spending and limit that spending on essentials. And this causes economies to dip into an economic phenomenon that we call stagflation, which is the most destructive economic phenomenon out of all of them. And it's happening globally. The GDP is going down because consumer activities are slowing down, yet inflation continues to move higher, not just in the US, in the UK, in Italy, in Germany, in France, in Canada, in Brazil, in Korea, in India, all over the globe. We're seeing massive stagflation. Stagflation destroys everything at some point. And this is why the results that we got from Walmart and Target are extremely alarming. Now, would you agree that spending at Walmart and Target is essential or not? I think it is essential because the consumer is spending on food. Is there anything more essential than food? Well, if the consumer is cutting spending on food, isn't this a major problem here? Isn't this an indicator that the consumer is weakening significantly? And as a result, we will see the economy collapsing without consumer spending. If the most essential companies, the most defensive companies, the most inflation resilient companies, the likes of Walmart, the likes of Costco, the likes of Dollar General, the likes of consumer brands, Procter & Gamble and the likes, if these names start to get hurt, then boy, the economy is collapsing. And this is exactly what we're seeing at Walmart right now. This is the biggest loss in Walmart stock since 1987. We're talking about billions of dollars wiped out of Walmart stock. And perhaps the only silver lining is the Walton family lost over $16.5 billion in a single day. Now, luckily for the Walton family, they've been dumping stock last year like crazy. They've cashed in billions of dollars while the moronic retail mom-and-pop investors been chasing the bubble and the lottery ticket in the stock market. Here is the results from Walmart. Again, when we look at Walmart US, the revenues, net sales were up 4% year over year, but operating income is down 18.2% year over year. Stunning. Walmart International, the picture gets even more drastic. Sales are down 13%, and operating income is down a stunning 33.7%. We'll look at Sam's Club. Sales are up 17.5%, yet the operating income is down 20% year over year. Why? Here's why. The net revenue for the company, all in all, Walmart, was up 2.4% year over year. So far, so good. But inflation is crushing them. The cost of sales up 3.5%, and expenses are up 4.5% year over year. Now, you have a dynamic where the growth in sales is slower than the growth in the cost of sales and expenses. What do you think will happen? The bottom line, the net income is down a stunning almost 25% year over year. Now, you might say, hey, Maverick, why did the stock react so negatively? A crash, pretty much, in Walmart. Because before this report, the stock of Walmart was pretty much at the same point it was trading at last year. Why are we seeing this oversized reaction to the downside? Here's why. Look at the number in 2022. to net income. Let's say it's $2 billion, right? Now, would you say that Walmart should be producing higher profits today, this year, than 2019, for example, before the thing, the shutdowns, and the stimmies and all of that? I think that's a reasonable assumption, wouldn't you say? Well, here's the reality. Remember, $2 billion almost in net income and profits for the first quarter of this year. In 2019, the net income from Walmart for the same quarter was almost $3.8 billion, meaning inflation is now crushing Walmart's earnings big time, to the point where their profits are below 2019. Every single gain that Walmart accumulated since the crash of the thing, well, now it's poof, gone, and then some. This is the destructive power of inflation. And it wasn't just Walmart, by the way. Look at Target, for example, one of the most resilient retailers out there. It has been producing excellent results so far, until today. The revenue year over year was up 4%, but here comes the power of inflation. The cost of sales up 10.4%, and expenses are up 5.6%. Now you have the same dynamic as Walmart. The rate of growth in revenues a lot slower than the rate of growth in costs and expenses, and therefore the result is the net income is down a stunning 52% year over year. Now you understand why the stock of Target went down big today, losing almost a quarter of its entire value. So we're seeing two things here. The consumer is shifting their spending habits. They're spending less in the economy. We're also seeing companies being destroyed by the power of inflation. If Walmart is paying a lot in diesel, for example, to transport all of these goods, there is a limit where they can pass that extra cost all the way down to us. At some point, they have to eat the loss, because passing the extra cost to the end consumer will result in a loss of competitive advantage. In the long run, this is more destructive to any company than eating a loss for a quarter, for a year or two. What else happens under stagflation? Well, the economy slows down. Hiring slows down. We're seeing alarming signs of the upcoming tsunami of layoffs. For example, Netflix is already laying off 150 employees, and more to come as they continue to deal with subscriber losses. Meta, also known as Facebook, is also cutting spending because they cannot afford to fund certain projects. The stock is down big. They cannot take more loans. Their profits are down. Inflation is eating them away. So what is the resolution here? Number one, you stop capital expenditure on certain projects. That causes more stagflation because the GDP, the pace of economic activities, stagnates and moves down while inflation continues to linger around. And soon enough, you're going to see a company like Meta laying off thousands of employees. Wayfair is also freezing hiring right now. And today we got a stunning revelation. Amazon is cutting back on hiring this year. Why? Their sales are slowing down. Their profits are getting crushed. Inflation is absolutely decimating Amazon. They cannot hire more people. And soon enough, as the economy starts to slow down, they're going to start laying off thousands of employees. So what happens in step number 7? Well, the Fed notices finally they wake up from the coma, maybe not, and they realize that inflation is destroying the economy. We cannot let inflation continue to go. Inflation doesn't go away on its own. Inflation requires action by the Federal Reserve. The problem is, one would hope that the Fed is ahead of the curve and they start tightening the monetary policy, meaning attacking inflation while the economy has the cushion to absorb the hit. But the longer they wait, the more dangerous it becomes, because we start to see companies like Walmart getting destroyed, getting absolutely whacked. Their profits are down. We start to see companies laying off employees. Then comes the Fed on top of that, adding to the misery by tightening the monetary policy. And that could cause a massive, massive recession, if not a depression. And therefore, we continue to say the Fed is way behind the curve. The Fed must act right now, because if they don't, they're going to have at some point to slam their foot in the brakes when the economy is already too weak to absorb the shock. But the Fed lives in this fantasy that inflation is still transitory and inflation is going to go away on its own. They don't have to do anything at all. And this is a very dangerous way of thinking. Take, for example, the demon from Minneapolis, Neel Kashkari, one of the most dangerous Fed presidents ever. He's now saying perhaps the easing of supply chains could limit rate hikes. He is still hoping that inflation is going to be transitory. And then he goes on and says, with the same mouth, whether the Fed's efforts are going to cause a recession or not. Neel Kashkari says, we don't know. Well, we know. I know. The later you are to the action, you're going to cause not just a recession, but a depression. You better act now, Mr. Kashkari. And here we have Jerome Powell, the orchestrator of this inflation crisis to begin with, due to his reckless policies and arrogance, by the way. Now he says nobody should doubt the Fed's resolve in curbing inflation. Excuse me, nobody trusts the Fed anymore. This is the same guy who told us it's going to be transitory. And then you have me, a douchebag on YouTube, not a Harvard, not a Yale, not a Princeton, not a Goldman Sachs, not a Morgan Stanley, who predicted from the get-go that this is going to be a massive inflation problem that will lead us into stagflation a year ago. So you're telling me that the Fed could not see this coming? Meanwhile, I did? How do you explain that? The Fed has a credibility problem, big time. And now Powell goes on and says, oh, there could be some pain involved in landing the plane, you know, the soft landing, the fantasy of the soft landing, that after this massive crisis, the Fed's just going to land the plane right. We're not going to lose a lot of jobs. The economy is not going to dip into a recession, and inflation is going to go away, and everybody's going to live happily ever after. Are you kidding me? And even Jerome Powell is waking up from this fantasy and saying, while he's aiming for a soft landing or softish landing, he also warned that cooling inflation without plunging into a recession will be challenging. Or you think, Mr. Powell? We still have these lunatics who say, oh, the Fed doesn't have to act aggressively right now because the economy is slowing down on its own. Here's what I say about that. Some might say the economy is already collapsing on its own, so the Fed doesn't need to raise rates further. Big mistake. Yes, the economy is falling apart on its own, but the Fed needs to replenish its ammo to stimulate the economy out of a recession. Right now, they're out of ammo. What do I mean by that? The Fed's funds rate is barely at 1%. If the economy dips into a recession on its own without action by the Fed, what tools, what kind of ammo does the Fed have in order to stimulate the economy once again out of a recession? 1 percentage point, they can cut down the Fed's fund rate to zero again. You think 1 point will do the difference? Are we going to go to negative Fed funds rates? And by the way, if you thought it's bad here, wait till you see the Europeans, because the ECB is way behind the curve. They already have negative interest rates over in Europe. If their economy dips into a recession, what tools or what kind of ammo do they have to re-stimulate the economy? Folks, this is getting scary. In any case, what happens in step number 8? A crash. In the equities market, in the real estate market, in the bonds market, and we're already seeing the beginning stages of that. And then comes the recession. And even JP Morgan's boss, gangster Jamie Dimon, who last year said he sees a boom coming. Well, now Jamie Dimon is flipping and saying that he warns of powerful forces that threatens the U.S. economy into a recession. And even Goldman Sachs, former CEO of Goldman Sachs, says very, very high risk of recession in the U.S. economy now. Wells Fargo CEO says it's going to be hard to avoid some kind of a recession. Ben Bernanke, the ex-Fed chair, says that he sees huge warning signs on inflation, stagflation, and student debt. Morgan Stanley now says there is a 27% chance of a recession in the U.S. in the next 12 months, up from 5% just 2 months ago. Now give it a few weeks and Morgan Stanley will finally admit that there is a 100% chance of a recession in the U.S. in the next 12 months. And even hedge fund managers are now waving the flag, the white flag, and saying we were wrong in pumping equities, tech stocks, and all of that garbage in the bubble, in the everything bubble, the most insane bubble in financial history. They're admitting that they're wrong, and oh, by the way, the recession is already here. Folks, once again, I wish I had better news for you, but it's not looking good. So buckle up your seatbelts and let's move on to cover the stock market information for you. We begin with the closing of the indices today, and here we go. Oh boy, just when you thought things are looking a little better, here it is. The Dow Industrial Average is down 1,164.52 points, or a decline of 3.57%. The Nasdaq getting absolutely whacked today, down 566.37 points, or a decline of 4.73%. The S&P 500 also down by 165.17 points, or a decline of almost 4%. The sector's performances down across the board, shame on all of them. We're not going to give medals at all, but look at the decliners. We're not seeing the cyclicals and technology down on their own like we see in bad days usually this year. We're seeing defensives down, obviously due to the crashes in Target, Walmart, and the rest of them. But what does that say? When you have cyclicals, technology, and defensives down, and you only have energy and utilities holding some kind of a ground, that tells you we are in stagflation. Commodities are still holding ground, at least for now, but sectors with consumer activities such as defensives, cyclicals, technology, industrials are falling apart. Here's the advance to decline ratios. NYSE 10% advancing versus stunning 87% declining. The Nasdaq 17% advancing versus 78% declining. Now, here's the only good news for the market bulls. Remember a few days ago, we would see over 1,000 new 52-week lows in the NASDAQ. Today, with all of the declines, we only made 211 new 52-week lows. Number one, that says the last low is still intact for now, and the majority of the losses that we got today came from the big caps. We're not seeing the names that were already hammered making new lows. So this is an important small little indicator that nobody's going to talk about, but I'm talking about it. So a glimpse of hope for the bulls here, that whatever we got today, maybe it is an overreaction. And underneath it all, under the hood, the market is saying we're seeing extreme oversold conditions here. With that being said, we're moving on to commodities, a bloodbath across the board with very few exceptions. Energy down. Matter of fact, the WTI down almost 5% today, while Brent down a little over 2%. Gasoline is down almost 6%. It's going to take a while before you see the reflection at the pump. And then we have heating oil down a little over 3.5%. When we talk about softs, down across the board. Lumber down, coffee down, sugar down, OJ down, cotton down, cocoa down. Everything is down. We're seeing sizable losses here. Lumber is down over 6%. Coffee is down over 4%. OJ down over 3%. When we talk about metals, gold is holding ground for now, pretty much flattish. But again, we're seeing the rest of metals also getting creamed today. Silver down, platinum down, copper down, palladium down. Everything is down. When we talk about meats, live and feeder cattle futures down modestly, and by modestly we mean almost 1% apiece. This is considered modestly when you factor in what's happening across the board. But here it is, the new big tech, lean hogs, baby, holding ground and gaining almost half a percentage point today. Grains, red across the board. Soybeans down, soybean oil down, corn down, wheat down, rough rice down, oats, canola down. Everything is down, with the exception of soybean meal, which scored gains of about half a percentage point today. The only better news that I got for you for commodities is the following. Yes, crude oil prices are down, but mind you, your boy Joey B has been depleting the Strategic Petroleum Reserve, and now the SPR is showing the lowest levels since 1987. What does that mean? Sooner or later, the SPR has to be replenished, meaning the U.S. government has to buy millions of barrels out of the open market, meaning we could have a put here, courtesy of the U.S. government, because let's say crude goes down under 100, for example. And then the U.S. government looks around and says perhaps China is going to reopen and we see the resumption of demand from China. And therefore, let's say, sake of the argument, at this point, crude is trading at 95, 90, and the U.S. government says, okay, this is good enough. Let's replenish the SPR. And that would be the put, pushing oil higher. Moving on to the big casino, the options market, what's going on here? The volume is dead. And folks, we talked about this before. We need 4 conditions for the sustainability of this rally. We need short covering. We saw some of that earlier this week. Then we need retail participation in buying calls. This has yet to happen. We're not seeing folks buying calls. The volume is down big across the board, and the put to call ratio, we're seeing more and more buying of puts rather than calls. But number 3, my conditions in the sustainability of any rebound or rally is a cooling down of the U.S. 10-year yield. And number 4, a cooling down, or better yet, a reversal in the U.S. dollar. We saw that yesterday, but not today. So in the beginning of the week, we had at least 2 out of the 4 being met. Number 1, the short covering. Number 2, the drop in the U.S. dollar. Now, we barely have 1, which is the 10-year yield cooling down. But the dollar is up. Short covering is not happening anymore. We're seeing names heavily shorted like Carvana, for example, dropping 15% today alone. And then we're not seeing retail participation via buying calls. In any case, Apple came at number 1 at around 1.5 million contracts traded today. About 51% of those were calls. At number 2, AMD, at around 825,000 contracts traded today for the name. About 57.5% of those were calls. And at number 3, Tesla, at around 700,000 contracts traded today. Around 42% of those were calls. I mean, look at this. Tesla, one of the retail crowd's favorite names, we're seeing at least 58% of the volume of the contracts traded today as puts. People betting against Tesla. People hedging their Tesla shares, not betting that the stock is going to go higher. This is a bad sign. And here's the unusual activities that took place in the options market today. We start with the ticker EEM, Emerging Markets ETF. They're buying puts here, betting that these emerging markets are going to go down big. They bought the 32 puts for the expiration date, July 15th, with the expectations the name could go down by more than 20.5% by then. Now watch out here, because the bid to ask ratio is extremely wide. And the reason is we're not seeing a lot of open interest in this trade. Somebody just initiated the trade, but if you're going to get in now, you're going to pay around $3 a piece, which is going to cost you around, in this case, for the same volume, $22.5 million. And then we have the ticker FDX for FedEx. They're buying puts. Another bad sign because they're betting against the cyclical health of the economy. They're buying the 180 puts for the expiration date, July 15th, with the expectations that FedEx could go down by more than 11.5% by then. They paid around $7 a piece to enter this trade. All in all, spending around $10.5 million. And then we have the ticker BJ. And no, this is not the kind of BJ you're thinking about, although the ticker below that is Grab, so grab BJ, I guess. Anyhow, this is for BJ Club, another retailer down big, over 10% today. All of them are down. Any retailer got absolutely creamed today, and they're betting for more pain to come. They're buying the 45 puts for the expiration date, July 17th, with expectations that the name could go down by more than 16% by then. They paid around $2 a piece to enter this trade. All in all, spending around $2 million. And then we have the ticker QQQ for the NASDAQ. They continue to buy puts here, the 268 puts for the expiration date, June 17th, with expectations that the Qs can go down by more than 8% by then. They paid around $5.25 a piece to enter this trade. All in all, spending around $3 million. And then we have the ticker BBY, Best Buy, another retailer. Doesn't matter if the retailer is doing good or bad. All of them got hammered today. And now we're seeing the impact of ETFization in the stock market. I have been a critic of ETFs for a long time, and I've predicted that once we see a crash, the crash is going to be exacerbated, and the reason is the ETFization of the stock market. You dump the good, the bad, and the ugly. Today they dumped the XRT altogether, and that impacted the BBY Best Buy. However, in this case, somebody's saying this is not fair. Best Buy is perhaps doing good. Now, I'm not saying that the company's doing good or bad. I have no idea what they're doing right now. But somebody's saying that the selling was indiscriminate and unfair. And therefore, they're betting for a rebound in Best Buy by buying the $80 calls for the expiration date, May 27th. With expectations that Best Buy could rebound higher by more than 7% by then. Or excuse me, 6% by then. They paid around $3.60 a piece to enter this trade. All in all, spending around $2 million. And by the way, if you want to open spreads instead of buying the $80 calls naked, at the bottom of the table we have another trade which is connected to this one. If you want to open spreads, you can buy the 80 calls and sell the 90 calls. That'll take your entry cost down to around $2.50. But here it is, the last one, AAPL Apple. They continue to buy puts, in this case the 133 puts for the expiration date, May 27th, with expectations that Apple could go down by more than 5.5% by then. They paid around $1.35 a piece to enter this trade, all in all spending around $675,000. Moving on to the heat map analysis. Can we do any analysis here? Of course not. It's a bloodbath across the board. They're dumping everything. We're seeing the negative impact of ETFization of the stock market, dumping the good, the bad, the ugly, doesn't matter. Everything is down, tech down, financials down, cyclicals down, even energy down, materials down, defensives down big. We have few exceptions here and there. TJ Maxx, for example, in the heels of earnings. And then we have Philip Morris Tobacco holding on, pretty much in the flat line. Verizon, another defensive name, holding on the flat line. But besides that, it was a world of pain across the board. The only story that I have for you here in the heat map for individual names is Wynn Resorts. Now we have the Department of Justice suing Steve Wynn because he failed to register as a Chinese agent. This is absolutely hilarious because back when I used to work in the casino business in Las Vegas, when you told people that you worked for Wynn, they'd be really impressed and say, wow, you must be making a lot of money, yada, yada, yada. This is the power of branding by Mr. Wynn. But if you said you worked for MGM, Caesars, whatever, nobody would give a shit anyways. And of course, I had the pleasure of meeting Mr. Wynn at some point. At that point, he was already blind. He could not recognize anything, but at least I got the selfie. Anyways, moving on to the heat map for the ETFs. Again, a bloodbath across the board. Everything is down unless you bought some inverse indices, or if you bought the VIX proxies, VXX, UVXY, or even the TLT was up. But besides that, a bloodbath across the board. Maybe you were spared from the storm if you were hiding in utilities. Utilities, XLU down almost 1%, and gold. Gold pretty much in the flat line. Look at the GLD, ARU pretty much flat for the day. And flat in a day like this is good. Let's move on to the chart analysis, and we start with the SPY. We have a lot to talk about here. This is a 30-minute chart, and the numbers are important, folks, and I'm going to illustrate that for you in a minute. But we now have the last support for the SPY, 385.15. Keep that number in mind mind because we're going to talk about it in a minute. But let's zoom in so I can show you what happened today in details and the intraday, the day trading opportunities that the chart presented for us today. Here's a 5 minutes chart. The chart opened gapping down. So right away, you're looking at 401 as the first support. And the chart goes down, consolidating, holding that support for a little while. And then it goes below that. And then as you can see, I'm highlighting for you the attempt in reclimbing 401 as support again. That did not happen. And the chart went down all the way to 398. Now, would you initiate a short from 401 all the way to the next support, 398? In my book, it's not worth it because it's a tight range. I don't want to short from 401 and then I go down to 398. And then what do you know? The chart blasts higher again. I don't have time to get out of the trade. So I'm waiting for a rejection from 398 so I can ride all the way down to 392. So the chart goes down, breaking below 398. And then as I'm highlighting for you right here, you see the reattempt in recapturing 398 support. That was met right away with rejection. That was the confirmation to place a short right there and then. And then you go down all the way to 392.39 and you close right there. That is a day trade, intraday trade. But guess what? Even after that, the chart violated 392.39 as support. Now, your question might be, did you go short, meaning buying puts on the SPY for good with the expiration date of June, July? The answer is no. This was just a day trade. I was looking at the charts and I could not help myself. Sometimes the chart's going to give you a day trading opportunity. I'm not a day trader, by the way, but when I see opportunities like this with the numbers defined, the support, the resistance really clear, you can't help but take the shot. Now, I'm not going to place a put trade, a short for the SPY, committing serious amount of money until we see 385.15 lost the support. Because if that happens, we will see a cascading impact, a flush down, margin call kind of selling. Because for all you know, you might have got excited by the action today and you bought a lot of puts on the SPY. What do you know? Tomorrow, for example, they come out and say, oh, Costco says they're not seeing the negative impact that Walmart and Target is seeing, meaning that these woes are limited to Walmart and Target, not to Costco, for example. And here we go, the SPY pops higher again, and the pie factory becomes busy once again. Warm, nice pies flying left and right. You don't want to be in that situation. So we're limiting the trades to intraday trading opportunities, in, out, hello, goodbye, and always be closing. And for now, not placing the major put options trade again until we see 385.15 lost the support in the SPY. Here's the daily chart for the continuous contract for the SPY. And again, major problem for the S&P because it lost 3,960 support. The volume went higher slightly, indicating that perhaps we have not reached selling climax. On top of that, the momentum indicators, specifically the MACD, is curling down again, failing to cross, producing green impressions on the histogram. Now, the candle from last night might have shown green impressions on the histogram, but that was not the closing. So we have yet to have a confirmation that this is a tradable bottom, and therefore we're seeing a massive reversal today. Now, we could see another pie coming, by the way, for those who bought puts today, if the chart, for whatever reason, reclimbs 3,960 once again. And therefore, I say not buying major put options trades here until we see the lows being taken out. In this chart, the low is 3,850. If that number is taken out, then I'm placing puts once again. But absent of that, I have eaten a lot of pies in my life, and I'm trying to lose weight. Anyways, here's the cash index, the SPX. And again, we're way below the 200 days moving average in white, as you can see. Now, a lot of folks, a lot of technicians would say that the reversal and losing 4,000 as support should automatically trigger a short right there and then because 4,000 is lost. I say, technically speaking, you're right, but I'm not interested until I see the lows taken out. But make no doubt about it, this is a major loss for the bulls. The hope was that the SPX goes all the way to at least 4,200, and then the chart reverses down again. By doing so, at least we could have said that 4,000 is support for now, for a few weeks, for a few months. But right now, 4,000 is gone. How low can we go, you might ask? Well, we have to zoom out to the weekly chart, and we have the 200 weeks moving average, which has been acting as support over and over and over again throughout the years. And if we go down there, it's going to be around 10.5% from this point on. And that will happen by the summer, let's say July, August. And that support should hold. But for now, we're not even close. So we're not going to talk about it a lot. We're going to stick to the dailies and the intraday charts. Here's the Qs, a 30-minute chart. And again, notice the numbers that we're talking about. We have 299.24. 294, that's the gap, and then we have 297.5, that's support, and then we have 291.21, that was the gap below, and now we have 285, almost 285 as support. When we zoom in to a 5-minute chart, again, a gap down in the morning, but the good news is you have the numbers. You have 299.24. The chart went back and forth, retesting that number as support, and eventually it failed. Now, do you place a short right there at 299.24 to 297.5? For me, the range is too tight, not worth it. I'm waiting for a rejection from 297.5 to go all the way down to 291.21. Now that's worth it as a day trade. So as I'm highlighting right here, we got the rejection. Once 297 was breached, and then the chart went higher in a retest to 297, 297.5, and it got rejected. We got another candle, a down candle, from a 5 minutes perspective, and that was the shorting signal right there and then, all the way down to 291.21. Now, the chart closed below 291.21. That's bad for the bulls. This is not good news. But again, this was a gain of around 1.5% in a single day. When we talk about options, the gains are way higher. But your question is, are you buying puts for real? Like buying puts with the expiration date June, July, August? The answer is not yet. The answer is I'm waiting for 285 to be breached as support. If that happens, then I'm going to buy puts for real. But for now, who's to say that this is not a bear trap? They're going to trap a bunch of bears and then force them to cover by whatever news they're going to pump tomorrow. And therefore, we have to be patient here. And here's the daily chart for the continuous contract for the Qs. We were looking at the MACD indicator yesterday, and we had a tick, a green tick from the overnight candle. But the overnight candle did not close. It closed today, and it closed ugly, losing the support of 12,207, and therefore we don't have a crossing in the MACD. We don't have a confirmation that this is a tradable bottom. Now that could happen as soon as tomorrow. We could see a closing, a decent closing, reclimbing 12,207. We see a green impression on the histogram, but for now, we don't have that confirmation yet. And the bears don't have the confirmation to short for good to commit a decent short until the lows of 11,689 is taken out. Here's the IWM 30 minutes chart. Once again, you have the numbers 181, and then you have 177.14, then you have the support 174.22. We did not get there, so we're not going to talk about it. But when we zoom into a 5 minutes chart, here it is. The chart gapped down. So you're looking at what? You're looking at 181. It got rejected once, it got rejected again, forming a bear flag. That was a sign to go short. And then we got the confirmation candle, and we got the flush down all the way to 177.14. Then we got the double bottom. That was a decent chance to cover and book profits. But guess what? The chart went down again, violating 177.14. It retested it, and it got rejected by the end of the day. But it was a decent intraday trade, a day trade. But again, just like I said with the SPY and the Qs, I'm not shorting for good because, for all you know, this is a trap until the previous lows are taken out. Here's the Dixie, Tricky Dixie, once again, popping higher. We're not going to say the dollar is done here until 103 is done as support because, as we've seen today, the dollar continues to move higher again. The strength is amazing. It should be topping right now, but we need a confirmation. The confirmation is 103, no longer support. What about gold? Gold, steady Eddie, nothing going on here. And steady Eddie, flat line, that's good, considering what happened in the SPY and the Qs and the IWM and the rest of them. So for now, we're waiting and waiting and waiting for the dollar's next move. Likewise, here's the 4 hours chart for Brent crude oil. We have, it appears so for now, a triple top at around 114, 115. So we're not going to buy futures contract on crude until 114, 115 is beaten as resistance. For now, we don't have that signal yet. That doesn't mean that oil stocks are bad. Oil stocks trade differently than the futures, not in the long run, but in the short run. You can see divergences where the futures are down, yet oil stocks are higher. Here's the 10-year yield. We got another down day. So far, so good for the 10-year yield, meaning we still have the possibility of a head and shoulder formation, or we still have the possibility of a bear flag formation. If that happens, a flush down in the 10-year yield could be good for the equities market if it means that inflation expectations are going down. But if it flushes down with the premise of the economy slowing down, that would be bad across the board, because the 10-year could go down for multiple reasons. Among them, inflation expectations going down or growth expectations going down. If it is inflation expectations going down, good for equities. If it is growth expectations going down, bad for equities. Here's the TLT daily chart. We're having a pop off the bull flag for now, still intact. And if it continues, we go to 125.12. Here's a 4 hours chart for the VIX. The VIX is popping higher again. We're seeing a confirmation in the MACD. We're seeing a green impression indicating the end of the negative momentum, the beginning of the positive momentum in the VIX. Is this good news for the SPY? Of course not. On top of that, we have a double bottom formation, the negative divergence on the RSI is being erased. But again, in a day like this, you would assume that the VIX should be exploding higher to 40, 45. Not the case. And a lot of analysts, of course, say this is perhaps a sign that we're not at the bottom yet because we have to see the VIX at 40, at 50. Now, when everybody thinks that the bottom is going to happen when the VIX pops to 50 or 40, it's probably going to happen before that. But why is the VIX not popping higher in a massive down day like today, for example? It could be the fact that yes, people are buying puts, they're hedging, but the volume is down when you pin it to the previous weeks, to the previous months, to last year, for example. So we're not seeing that oomph that could take the VIX really higher because the volume all in all in the options market is down for both calls and puts. Here's the VXN. Unlike the VIX, we're not seeing confirmation here in the VXN, not from the RSI, not from the MACD, that the negative momentum in the VXN is over. Yes, we have a move higher today, but we're still below 40. So watch out here. The action that we got in the Qs could be a bear flag until we get a confirmation in the VXN by popping above 40 once again, and we see green impressions on the histogram of the MACD. Here's Apple, a daily chart. We have a big reversal in hand. The chart abandoned its goal in reclaiming 150 as support, and it lost 145 as support. We're now looking down at 138.79 as support. But again, we're seeing mixed signals here. What do I mean by that? Number one, yes, the momentum indicators are negative divergences, but the volume, while it went higher today, it remains below average, meaning we're not seeing conviction in the selling here. And therefore, I'm saying wait till 138.79 is breached as support, and then you can short. Because if you short today, or if you shorted today, I should say, who's to say that you're not going to wake up in the morning with a nice warm pie in the face, whatever news the plunge protection team is going to bring out, and you see Apple reclaiming 145 as support. So watch out here. Here's Tesla, 1 hour chart. We're now dancing at 700, the most important support line. You break 700, you initiate the short trade big time. We're going to see Tesla flushing down big time. I'm going to double down, triple down, buying puts on Tesla if 700 is gone. But for now, the good news for the bulls, they're keeping 700 as support. But we have bad news for the Reverend Elon Musk. Today, he tweeted, in the past, I voted Democrat because they were mostly the kindness party. But they have become the party of division and hate, so I can no longer support them and will vote Republican. Now watch their dirty tricks campaign against me unfold. Now, I don't know what to feel about that. Yes, the Democrat Party is disappointing, to say the least. Not sure I'm going to vote Republican either. But why is he saying this right now? Does he have prior knowledge that he's going to be under the microscope of the SEC, the NHTSB, for example, and he's hedging right now and saying, watch out, whatever bad news you're going to hear about me and Tesla, that's because I'm voting Republican, not Democrat. Because we know the pitchforks are coming. But does he know? Does he have prior knowledge of what's about to come and he's hedging or not? Or are the pitchforks coming anyways for him? Because today, even before the tweet, we got the news that Tesla is removed from the S&P 500 ESG index. Why? Because on top of that, the regulators finally waking up from the coma and opening a probe in the crash that killed 3 people here in California. Now, all of this news came before the tweet, but Elon is probably hedging and saying all of this is happening because I'm challenging their power and I'm voting Republican now. I'm buying Twitter. I don't know what to feel about this, but the regulators have been in a coma. We've been calling in this program over and over and over again the safety issues of Tesla. But back then, your beloved politicians were all long Tesla. They all have calls in Tesla. So of course, they blocked any investigation in the company. Now, the demand is challenging the deep state globalist oligarchy that we have, and he's supposed to be part of them, by the way, but he's not, at least for now. And he decided to buy Twitter, and now he says he's voting Republican. Oh yeah, the pitchforks are coming. Your beloved politicians are dumping their Tesla shares. Hey Elon, you think you're a big shot? You have this bubble stock that you got, you're using it to buy Twitter and act like a big shot, challenging our monopoly over news and information? Well, watch out. We're dumping your stock. We're going to unblock all of these investigations of your company, and down you go. Anyhow, moving on to Tulips BTC. Again, acting a little better than equities, and the chart once again is asking, any buyers, any buyers, any buyers? Because we have seen selling climax in cryptos before stocks. If the buyers are going to show up, then we're going to see the bear flag out of the picture and BTC goes higher. But a few more days of no buyers showing up, the sellers will, and we will see a flush down in cryptos. And by the way, the margin calls in cryptos, not in Bitcoin necessarily, but in the other tokens, is impacting the stock market negatively because the brokers have to liquidate certain assets, in this case stocks, to cover the crashes in the tulip market. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the initial jobless claims, we also have existing home sales, we also have leading economic indicators. On top of that, we have the most important Philadelphia Fed Manufacturing Index. With that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow. Take care.
You never really remember the beginning of a dream, do you? You always wind up right in the middle of what's going on.
I guess, yeah.
So how did we end up here?